Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week I'm speaking with Steve Howe, quantitative researcher at Bloomberg. Now, Steve, thank you very much for joining us. Very good of you.
Very nice to speak with you, Merryn, and thank you for the invitation.
No, I wanted to talk to you this week because this week is macro week, right? Everybody else is going to be talking Trump, talking tariffs, talking inflation, all this kind of thing. And so we're just going to leave that for everybody else because, to be honest, no one really knows what's going to happen with the tariffs. No one really knows what the macro effects are going to be. There's a lot written on. And we are going to go a little bit more micro and talk about things that directly affect companies that we can understand. So in particular, innovation, how pricing power works, how analysts look at companies, all this kind of thing. So all the areas that are specific to your work. So what we're going to try and do is not mention tariffs once. In the whole 40 minutes that we're going to speak. It's going to be like a challenge between us, okay? No mention of tariffs. Can we do it?
We should try. Yes.
Okay. All right. Everyone's going to let us know immediately if we fail, of course. So I want to start by talking about the thing that, of course, everyone talked about last week, about innovation, discovery, in particular about AI. So everything that's happened over the last couple of years with AI has really been the most extraordinary wave of innovation and change. And then we had the news on DeepSeek, of course, only hit the market last week, but in fact was out there several weeks before that. And that represents massive change as well. So that's exciting, but there's a lot else out there, right? It's not just AI at the moment. We're in the middle of an extraordinary wave of technological change. What are the most interesting parts for you?
So first of all, a little bit of background on myself. I'm a quant researcher at Bloomberg Indices, and I create systematic strategies where we use, different signals to try to identify stocks systematically to create investment strategies. And one of the recent ones we've created is looking at innovation. How do you identify innovation in a systematic fashion? And what we found is, turns out that you can use R&D expenditures as a signal. Mm-hmm. And this is not new, right? Companies have, researchers have looked at R&D spending, for a long time and indeed identifies companies that are exposed innovative. But what we have found is actually the more indicative of research capability, innovative capability, is not so much the absolute amount of R&D spending, but the persistence, right? When we screen for companies that spend and persistently grow their R&D expenditure year on year for, say, 3 trailing years, right? Without doing just anything else, right, you autonomously pick up companies that are actually exposed, very innovative, and I should get into details as to how we actually show that they're indeed innovative because it's such a, sort of abstract thing. And what's really remarkable is that if you, say, screen the US large mid-cap companies, by this metric, right, and sort of market cap weight them with some sort of capping and weights, you get back exactly the cues, the Nasdaq Stock Exchange, which of course is just happens to be everything that's listed on the Nasdaq Exchange and not, explicitly screening for innovation, which we thought is very fascinating. And along the way, you also do pick up, of course, AI technology, but you also pick up things such as pharmaceutical innovations, Eli Lilly, which invented, along with Novo Nordisk, the GLP-1 drugs, the modern weight loss wonder drug.
So you look at companies and you can see trailing R&D spend over 3 years going up and up and up. And that gives you some sense that there's interesting innovations going on there. But of course, that doesn't help you choose between people who are using their innovative abilities successfully with a product that'll come to market and those that are not. And it also doesn't help you pick up the companies. So let's go back to AI, for example, where one of the things that was much discussed last week was the fact that so many companies are spending so much money, possibly on the wrong thing. So it's not helping you distinguish between good R&D and pointless R&D. And particularly when you get, for example, to say a bubble situation where you get that massive capex spending over a series of years, but you only get one winner.
Well, let's unpack that idea a little bit. So first of all, let's get back to the idea of just simply screening for companies with persistent R&D spending. You would think exactly like, how would I be able to tell whether the company is just throwing a bunch of money after bad, right? And there's one pair building and the money is just being set on fire. That indeed, that is a possibility. And what is surprising is it comes out when you screen for companies that persistently spend R&D instead of just sort of one on and off. These tend to be companies that actually have the certain ability or knowledge about innovative success, and that has been well documented in the academic literature. That there is actually persistence in skills, whether it's sort of investing skills or innovative skills, right? And it turns out, without explicitly screening, if you look at companies that persistently spend R&D, they tend to be companies with strong cash flows, internally generated cash flows, strong profitability, and high and low leverage. And the reason it turns out is because R&D is a fundamentally opaque and asymmetrical information activity, right? It is highly uncertain, it's extremely costly. So companies are going to struggle to raise external financing, whether it's debt or issue equity to finance it. So only companies that are confident in its own ability to innovate, to translate that R&D into valuable intangible capital that will produce cash flow streams down the road, will actually do it in a persistent fashion. And that's one thing, for example, you see when you take a company, say ARK ETF, for example, right? Look at the companies that are in the ETF, they actually have very high percentage of R&D expenditures as a share of net sales, right? That's a typical way people measure R&D. But if you look at the companies that have persistent R&D spending in that portfolio, it's not very high because those companies are not persistently profitable. So the R&D spending is on and off, right? In 1 year, they spend a ton, and the next year, they run out of money, they don't spend any. And the companies that we do pick up, in our, methodology, then is actually the persistence, right? There is actually an embedded quality screen.
Yeah.
And I think that combine that with the fact that if you are just doing a market cap weighting, which sort of people do these days, sort of matter of factly because it's become the convention. But you think about what it really means is that there is a sense of ex post market validation, right? That having spent all this money, ex post, you're getting the market valuation because you've produced intangible capital that's actually spitting out cash flows, and that's what's different about today's stock market compared to, say, the bubble of 2000, is that the bubble today is in the quality stocks, right? The bubble today is in the companies that are tremendously profitable, so much so they seem to have escaped velocity, right? They don't require credit, they don't require financing because they finance themselves.
Okay, so we have this link between a company that has regular R&D spending and quality, and that's the important part of the link. That R&D spending, as long as it's regular and consistent and rising, is also indicative of a high quality company.
Mm-hmm.
Yeah, if we're buying those companies in the US at the moment, we're really paying up for them, aren't we?
Quite right. Yeah. I mean, valuation has absolutely climbed over the last decade. I think 10 years ago, or more, I guess, when Buffett started buying Apple, tech stocks were really cheap. Right. And, how many years have we heard, the sort of a forecast of expected returns for US equities being lower than the rest of the world and keeps being proven wrong is because profitability keeps surprising to the upside. And along with it, valuation paid for them because there was this, desire for quality assets.
And do you think that rising and persistent R&D is a thing that is driving earnings forward? And
absolutely.
Justifies the valuations?
Yeah, absolutely. One thing we do in our white paper, which your listeners can look up when they just search Bloomberg Innovation Factor, and they'll find the blog. And in the blog,
we'll put a link in the show notes. You don't have to search. No searching required. It'll be in the show notes.
Perfect. Yeah, done for you. So you can take a look at the paper, and what we show is that if you sort of do an experiment where you go back in history and identify companies that were persistently innovative in biomeasure, right? Having spent 3 consecutive years of growing R&D, and look at their subsequent 5-year sort of key fundamental performances, you will see that these companies showed stronger growth in revenue, net income, free cash flow per share, and just along all the fundamental metrics, and that particularly accelerated over the last 10 years. So in other words, the selection is not just based on valuation expansion. We've actually identified companies that produced intangible capital that translated into earnings. And that is the reason why these companies are being rewarded by the market. And this is what is really particularly reassuring, is that this is a phenomenon that we've documented across the globe. It's not just in the US, it's in Europe as well, it's in Asia as well.
Okay, interesting. But when we look at that, presumably, you see the majority of the companies that fit these factors in the US. I mean, that's where we all perceive the main innovation in listed markets being. Let's put China to one side for a moment. If we're looking at the US, the UK, Europe, etc., it is in the US that we see that innovation in the main, and that's why we've seen that huge valuation expansion there, which has been the main driver of US exceptionalism and US outperformance since 2015 or so, is the perception and possibly the reality that all the innovation is in the US. Is that the case, or are you actually seeing that persistence of R&D spending in companies in, say, Europe or the UK as well?
Well, so you're absolutely right in that the bulk of the dollar, activity, innovation activity probably takes place in the US just because of the size of the market. And also, I think it was Jeff Bezos who recently made a remark, that observation that was really insightful, is because of the US risk capital markets that really finances, innovative activities. But that being said, there is less innovative activities, R&D activity in Europe. But where it does exist, markets actually rewarded those activities similarly as well, right? You saw this dramatic outperformance, and you see, market follows wherever the activity takes place. So whereas it used to take place more in Germany, Switzerland, in the pharma space, now it migrates more northward towards the Netherlands because of ASML, or because of, or Denmark because of Novo Nordisk and the associate supply chain as well.
Okay, so the innovation that you see in Europe is very much in the pharma area,
and AI for that matter, ASML and their suppliers, right?
Okay, and the UK? Can you chuck us a bone here?
Well, actually, interestingly, UK, I noticed the company in my research on, which we'll get to later on pricing power. I noticed that there was a company called RELX, and I was very curious what it is because the stock is absolutely ripping. And I realized it's actually a massive AI beneficiary because it turns out they are, I think, you may be familiar with the company. They own about half the world's academic, publications, right, journals. And you would have thought before AI that this was a deadwood industry, like who reads anymore, let alone academic journals. But it turns out this is basically a vast trove of extremely valuable data, and AI is all about the training data, and they're definitely benefiting from it.
Okay, that's interesting.
Oh, I mean, beyond that, of course, there is the pharma angle, AstraZeneca and so on. But but that's more traditional.
Okay, let's move on to talk about this pricing power subject. But before we get there, how does one invest in the companies that you've been talking about? Is there something we can do to get access to these persistent R&D spending quality companies across the board?
So with respect to innovation, right, you're talking about, we have Bloomberg Indices launched the R&D indices. So BR&D is the index, but then we also have a smaller set of companies with higher conviction that's called BInvent, right? So easy to remember, Monica. And on the back of that, we have actually licensed the indices to ETF issuers. First Trust, for example, has licensed BInvent to create an ETF with the ticker R&D in America. And we are also, I personally think that this concept applies equally well to Europe. And part of the reason why I'm in London this week is to try to persuade people that Europe ought to invest in itself and ought to invest in innovation because, the race is on and, by both necessity and risk reward, I think this actually presents a very interesting alternative to US innovation.
Okay, so if that happens, we might actually see the European markets pick up a little, which we already are this year, right? We're already seeing great performance from European markets relative to the US.
Oh,
Not
absolutely.
great,
Yeah.
Slightly better. Yeah.
Mm-hmm. Yeah, German stocks are killing it, right? Everyone's talking about Germany going into a recession, but the DAX keep hitting all-time highs, and and I think that's part of the reason why we're seeing this pivot of AI broadening out, right, away from the first phase of picks and shovels to more applications, software, and with AI, last week's news about AI being much cheaper to implement, much more sort of energy efficient. That means that everybody else can start getting into the game, and that's why software is actually doing very well.
And it's yet another reminder, isn't it, which apparently people do continually need, that markets are not economies, economies are not markets, and markets can move in completely different directions to economies depending on the starting valuations.
Absolutely.
Okay, right. So let's go back to what you were saying about pricing power. I mean, this is one of the basics of investing, is that analysts and investors always say they're looking for companies with moats, with monopoly power or oligopoly power of some kind, and with the ability to control their own pricing. So you would think that would be the kind of thing that would be very much out there in the market, and you wouldn't be able to find any pricing anomalies in that area. But I think you're going to tell me that I'm wrong.
We're going to go back to, I think, eventually we'll always go back to the quality paradox. But indeed, we've been looking at this concept of pricing power because over the last few years, so we were looking at this 2-3 years ago, inflation was all the rage, and everyone's asking, how do we actually capture pricing power? So everyone has their own ideas, and there's qualitative ways of capturing it. And people will throw all sorts of company names out there and claim that those companies have pricing power. I've seen claims of, Tesla has pricing power, Apple has pricing power, but does it really? How do we actually know? So we sort of did a bit of work and found that it turns out it's not so much profitable companies that have pricing power, because high profit margins can be eroded into, right, if you don't have pricing power. So either if you look at the case of Apple, right, the flagship iPhone price has actually not changed very much over the last few years, even though I'm sure cost has gone up tremendously for them. So how do we actually then sort of capture companies that do have pricing powers? In our opinion, you look at not the level, but the stability. In other words, the standard deviation of gross margins over the last 5 years, right? So again, there's a certain theme to how we sort of look at our systematic strategies here. And it turns out that the reason we focus on gross margin is because it's the least manipulated, accounting metric, because it's just the difference between the top line and subtracting the variable costs, including hourly wages. So the things that are most sensitive to inflationary shocks. Now, if you have a company that has pricing power, then if there's cost push shock, they can pass on the costs to customers. And if gross margin is growing, indicative of a demand shock, then they can supply into it and drive down the margin towards their target. So that's why we've constructed a measure where we look at companies with the most stable gross margins. Okay.
And so if you're looking at companies like this, you're going to expect them to be in relatively niche areas, like the company you were just discussing. Being in academic journals is not an area that other people are going to break into in a hurry, is it?
Indeed, yeah. That's one interesting thing that emerges from our systematic, our screen, is that you look at the companies that come out of the screen, they look incredibly either boring or, not really one you recognize. For example, one company that keeps popping up in the American version of the pricing power index is this company called Cadence Design Systems. Have you heard of it?
It sounds familiar, but I don't think I can straight up say I have, no.
So Cadence Design Systems, they design software for designing microchips.
That does sound boring. Yeah.
Right. So in other words, they are not the ones manufacturing the chips. That's a highly cyclical sector, right? That comes with boom and bust of demand of traditionally consumer electronics. They design the software with which these chip designers design chips. In other words, you would, even if your business is down a lot at AMD or wherever you are, you're not going to conceive of canceling your subscription to the software with which you do your work, right? So that's really what gives them the pricing power, is that they are a supplier in a rarefied space with which there's maybe a handful of companies and continuing consolidation, so that and it doesn't attract the attention of regulators because it's not in the category that people think of, because it's not consumer facing or very glamorous, right? And that's how the pricing power is actually maintained.
When you speak about companies like this, and in the category we were discussing for R&D, quality, etc., it sounds to me like you're making the case for active investment. You're saying this market is not particularly efficient. There's all sorts of anomalies out there. There's lots of places where investors can go to find companies that other people aren't looking at. Are you making the case here for a shift back towards active investment? Or are you really making the case for factor-specific or sector-specific ETFs?
That's a great question, Merryn. So I have a somewhat controversial, perhaps, view on this whole active-passive debate. I don't think of it as being... I think the better word is discretionary versus systematic, right? Like what I just described to you, the methodology, whether it's looking at the stability of gross margins or the persistent R&D growth, that's not particularly passive as much as you think about the traditional benchmark of just buying everything on the stock market, simply market cap weighted, right? This requires a certain, I think, particular set of rules, and actually involves pretty sizable turnovers in your portfolios, on every rebalance date. And depending on the signal you're looking at, that the turnover can be indeed quite high. So I don't know if that means it's not, in that case, active in some sense, right? It's not discretionary, right? The process is rules-based and fully systematic. And that gives you the consistency.
Yeah, so rules-based active investing.
I guess you can say so. I mean, there are quant funds out there, and would you consider quant funds to be active or passive?
Ooh, rules-based active. But it's still, so from what you're saying, it sounds like an argument for active ETFs rather than a traditional active fund.
I do think there is opportunity to the extent that investors want to, take a different view on things and try to, sort of capture the changing trends in the market. Because, let's be frank, it is incredibly difficult, if not outright impossible, to outperform the S&P 500. Well, the B500 in our context. We're here, we're talking about the Bloomberg 500 index, and for that matter, a systematic, R&D index that we have created here. Like if you just simply have that, benchmark view, that gives you essentially a core holding that's really hard to outperform. But then if you want to do some things along that, if you have certain macro views or micro industrial views, that's how you can express it. And in our opinion, you should do it in a systematic fashion.
Yeah, fair enough. Okay, well, let's look at one more of the things that you've been writing about recently, which is about turnaround companies and the way that analyst ratings might give clues as to where those turnarounds are. You wrote on that middle of last year, right?
I did, yeah. So, yeah, that's another interesting idea that we were looking at. Here at Bloomberg Indices, we try to leverage the various types of data, on the terminal that are, I think, somewhat unique. And I think one thing is what everyone looks at is analyst ratings, analyst opinions, about stocks. Of course, a first order intuitive thing one will look at is just to buy all the stocks that analysts are recommending you to buy. And we were thinking, is there maybe a slightly different, view to, or approach to it? In particular, can we think about, companies that analysts are becoming more bullish on? And that led us essentially to looking at this idea of looking at analyst rating momentum, but ignoring the ones that analysts tell you to buy. So on the Bloomberg terminal, if you look up any stock and you type the function ANR, you see a score going from 1 to 5, 1 being strong sell and 5 being strong buys. If you just toss out the ones that have a rating of 4 and above, in other words, a buy or a strong buy, and then you look at stocks whose consensus rating has improved the most between the last 6 to 12 months, and you buy those stocks, we found that that's actually tended to capture a set of companies that the way we can think about summarizing them as being basically turnaround companies that are sort of have fallen on hard times. They were hated or not so much, or not at least not beloved by analysts. But analysts are like starting to change their minds on those stocks before converging to consensus, if that makes sense.
Yeah. So the general idea being that if you're only looking at stocks that everyone already has a buy on, it may be too late.
Indeed, so yes.
So all the gains are in there. So you want to be looking for. I mean, analysts they're going to be slightly late to things, aren't they? By definition, by the time everyone's caught hold of a story, it's already underway. So it's is it contrarian to buy something where people are beginning to turn their minds? Yeah, because you've found the bottom and you've found the catalyst, right?
Yeah. I mean, the way we think about it is that analysts over the long run, they're not wrong. They can be late. By the time everybody comes to love a stock, and give it, a strong buy rating, it tends to be that the price has already reflected, that strong sentiment and good fundamentals. So what we are capturing here is essentially that companies just about turning around, or from being previously, having been in a bad set of fundamentals and bad, sentiments to just about improving, right? And that gives you that asymmetric risk reward.
So you've got an improvement score. Have you got any examples in mind of companies that fit that mold right now?
Yeah. So there's a few examples that we go into in the white paper, which again we will link to. One of them is interesting. Recently is Oracle, right? Oracle, was actually having a hard time until the whole AI thing kicked off, and their consensus ratings were in the 3s and then improving a bit, and then the index sort of identified that company as a essentially a company whose analysts are changing their minds on, right? And indeed, then we picked up the stock, and the stock sort of goes up a lot because it catches this AI, turnaround, and also generally, I think the sector having bottomed. So that's one example, and another example we saw was actually. Hershey's, right? Hershey's, in the chocolate, industry, and
terrible chocolate, terrible chocolate.
What's your chocolate of choice? Milky?
Well, no, very, very dark chocolate. I'm a kind of lint 85% person myself. So, Hershey's is inedible.
Well, perhaps that's why.
But nonetheless, carry on.
That's why the stock has fallen on hard times, and the stock did fall on hard times.
I don't eat that much chocolate.
Yeah. So, and then it was getting hammered by the chocolate commodity ripping and eating into their margins, and then the stock was picked up because analyst ratings finally started improving, right, from trailing 6 to 12 months. We take an average, and then we saw basically the stock recovering, but then of course and that maybe this is the point with active and passive, is that because it's a fully passive and systematic rules-based, signal, you can pick up this. We pick up the stock, and then chocolate price, went down and it shot up again, and the stock went down again. So the index, the strategy didn't, react to it as quickly, as you would if you were in a fully discretionary, strategy. But that's sort of the general idea.
Okay, and is there an index for that as well?
Oh, yeah. So the index is, again, very simple. BANR is the index. Bloomberg ANR.
Okay. And is there a way to invest in that?
Yeah. There is a...
For the ordinary investor, obviously.
There is an ETF in America that Invesco has licensed the index, and the ticker is Upgrade, UPGD. That's...
Upgrade. Very good.
Actually, speaking of investment ways of investing, pricing power index in America has also been licensed, and the ticker is POWA.
POWA. That's not so good. That's not so good. I'm always interested in these tickers and the cleverness of some of them. There's somebody out there who does a great job on tickers, isn't there? Who chooses those? Maybe you knows that. Who works when you apply to have your ETF? Do you think of the ticker and you ask them, or is there someone clever around at the creators who make them?
I think this typically comes from someone creative on the asset manager issuer side. I too, like you, marvel at not just the tremendous creativity, but the availability of some of these tickers. You would have thought they'd been picked up by
yes.
I was very pleasantly surprised that R&D, the ticker was actually available. But there you go.
Well, interesting. I mean, I suppose that this tells you about the relative newness of the entire ETF industry, doesn't it?
Yeah, at least, in America, it's not so new anymore. I mean, it's all the rage, but we're trying to see if this become, the way in Europe as well.
Yeah. So what are you working on at the moment, Stephen?
So right now, we're working on a couple of things. One of them is we're trying to, think about shareholder yield as a concept, total shareholder return. I'm writing a white paper on that topic. So I don't know if you're familiar with the concept of shareholder yield. It was, sort of not just looking at dividends, but all forms in which companies can return capital to shareholders, which includes buybacks and debt reduction, right? This is not a particularly new concept. And it has done well, but we have given it our own spin as well at Bloomberg Indices, where we not just look at companies with strong total shareholder return, but to companies that have the consistent historical fundamentals to be able to afford those, strong total shareholder return. In other words, we're looking at a long history of free cash flow and capacity as a ratio to the total shareholder payout. That will allow us to eliminate more false positives that you might pick up, if you just screened naively for companies that happen to have very large total shareholder return.
Okay, interesting. So that's the results of that will be something for us to look out for. Assuming we can't see them quite yet. Thank you. Stephen, is there anything that you would like to tell our listeners that we have not talked about yet? Any perfect little insights, any brilliant investment recommendations, anything we haven't discussed that you feel they should know?
One subject we are looking more actively now is the idea of more macro-aware investments, because I think we've exited the age of moderation. The monetary policy, which used to be the only show in town, I think has taken a back seat, and we are now seeing more and more of these thematic trends, and macro volatility. So I think during this period, it's important to be more tactical. And one thing we are looking at increasingly is how do we identify sort of robust, simple signals that will allow us to essentially pivot between different views. Not so much market timing, because that we know is nearly impossible, but can we find ways in which that allow us to stay risk on and not miss the upside, while at key junctures, avoid the big mistakes. So one signal I've found in all of my macro research, it turns out that there is, if you look at the change in CPI, right, year-on-year inflation, that turns out to be an extremely robust and powerful predictor of, sort of asset performance. And what I'm talking about, for example, is if you look at today's inflation in, let's say, I don't know what's inflation in UK today, actually, because I normally follow the US. Let's say it's 2%, 2.2%. Let's just pick up a number, right? And if it was, say, 4.4% a year ago, right, inflation would have gone down over the last 12 months. that is actually a very powerful risk-on signal, because what follows from falling inflation is you tend to get all the good things, right? Stronger economic growth, stronger job market, higher earnings per share, higher productivity, higher consumer confidence, and lower bond yields. All of these things tend to be good for assets. Now, if you flip the picture and you say over the last trailing 12 months, if inflation had gone up, right? If let's say it was 2.5% and now it's going back to 3.2%, you get the opposite of all of those things previously. So how do we take advantage of this? So we created a index that is called dynamic equity duration, where we essentially calculate the implied cash flow distribution of stocks. And if inflation has been coming down, we'll buy stocks whose cash flows are further out, right? They tend to be growth stocks, risk-on stocks, right? And inflation has been going up, then we do the opposite. We lean towards companies whose cash flows are more near-term. And that, I think, we have shown to be actually a very interesting way to allow investors to remain risk-on, right? Ignoring all of the noise, right? You know, whatever it may be, whether it's DeepSeek, whether it's tariffs, or oops.
Whoa! We nearly got to the end. We were so close. So close.
Well, I couldn't resist. But anyway, but the point is that, you've had all this, what I think retail investors call FUD, right? All these sort of news that will give you a terrifying narrative. But if you just look at the trailing 12 months inflation and remain risk on in terms of equity duration, you would have actually done really well and avoided, the disaster of 2022, right? When, we had valuation compression.
Yeah. Okay. Interesting. So that's a signal that everyone can watch. One last question, David. Is there anything that you are reading at the moment that you are finding very interesting?
Yes. This is actually a great question, and I'm reading this little white paper / book called Situational Awareness, which I recommend to all of your listeners. This is a researcher who used to work at OpenAI, and he has written this long essay or / book talking about the path forward on AI, and there is one sentence in that intro that really made me curious. He says, everyone is now talking about AI, but few have the faintest glimmer about what is about to hit them. NVIDIA analysts still think 2024 may be close to the peak, but mainstream pundits are stuck on the idea of just predicting the next word, but they think everything is going to be hype and business as usual, but actually we're going to look at another internet-scale technology change. And I think what he talks about in that essay is going to be very illuminating for people who want to understand the implications of all these different news that comes along, that we are actually proceeding exactly according to script in terms of what the scaling law would have predicted. So what happened last Monday should not be surprising to people at all if they actually, read this little booklet. So anyway.
Okay, well, we will put the link to that in the show notes as well. I found that mildly terrifying. So I will, I've got some long plane flights this week. I will make sure that I read it then. Steve, thank you so much for joining us today. We really appreciate it. That was fascinating.
Oh, thank you very much for the conversation, Merryn.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending your questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW, and John is at John_Stepek. You can follow Steve on @SteveHoF. That is STEVEHOUF. This episode was hosted by me, Merryn Somerset Webb. The show is produced by Summer Sadi and Moses Andam. Sound design by Blake Maples. Special thanks to Steve Howe.